You are listening to Lender Lounge with Kevin Kim, a podcast dedicated to helping those in the private lending industry grow, improve, and streamline their business. I'm Kevin Kim, partner at Gerasi LLP, the nation's largest private lending law firm. Join me as we chat with the best and brightest in private lending, who are eager to share their years of wisdom and best practices with lenders, borrowers, brokers, investors, and more. Subscribe to Lender Lounge on your favorite podcast platform and learn more about Gerasi and how we can work with you at gerasilawfirm.com. Check out the episode summary for other valuable resources. Hey guys, welcome to another episode, a very special episode in between seasons of Lender Lounge with yours truly, Kevin Kim. This episode, we're doing it in conjunction with our friends at the American Association of Private Lenders because it's that important of an episode. I'd like you all to welcome our guest for the show today, John Beacham, CEO of Toorak Capital Partners. John, please introduce yourselves to those who don't know who you are, to our audience, and let's get started.
Hey, Kevin. Well, first of all, thanks for having me on your podcast. It's super exciting. And I've listened to many seasons of your podcast in the past, and lots of impressive people have come on here. So I appreciate your having me here for this special episode. I am John Beacham. I'm the CEO of Toorak Capital Partners. We're a company that's founded in 2016 that is focused on funding the residential bridge loan market, both across the U.S. and U.K. We partner with lenders who originate loans. Typically, they're small or short-term bridge loans on 1 to 4 family properties or multifamily properties that we then acquire after they're funded and then hold them on our balance sheet. So we have a pretty significant balance sheet of loans that we purchased over time.
So, John, you've been in, I would call it, real estate finance, I believe your entire career, right? So I want to, before we get into Toorak and we get into the primary reason why we're doing the show today is the rated deal you guys did, the very first one in our sector. I really want to spend some time on that. But before we do that, you've been in the industry now, since 16. Toorak's a household name in the space. Everyone knows who Toorak is. But I feel like a lot of folks don't know who John is, right? You've done a lot of media spots, but you guys have a lot of things to talk about because Toorak's doing some cool, always been doing some cool stuff. But I feel like John Beacham. I want to get to know you first, right? So give us a little bit about you, like your background, like where'd you come up, how did you get into our space, and all that? Because I feel like folks who know you don't like in the industry don't know like beyond Toorak or maybe beyond B2R, right? So give us some more background about you, John.
Sure. Well, thanks, Kevin. And so I was born in Georgia, grew up in suburban Chicago. And then went to high school in Manhattan. So it was a little bit of a culture shift that you can imagine. Then stayed in the New York City area, either in New York City or New Jersey since I went to high school, except for a couple years in Australia. So I actually moved over to Australia a couple years. So it's great to be the exotic foreigner with an accent when I was over there and lived in a city called Toorak, which is thus the name.
So the city called Toorak in Australia.
The city called Toorak, yeah. It's actually outside of, it's a suburb of Melbourne, or if you're American, Melbourne, but if you're Australian, Melbourne, Australia. And it's, I moved there. I didn't know anyone in Australia and lived there for a couple of years and just loved Australia, loved the city. I always had that name in the back of my head as something, if I ever had a company, I could use it to go name the company.
That explains a lot. That's cool. I like that. Well, how did you end up in Australia, though? Like, was it during high school, like an exchange program? Or?
No, this is, I went to college, I went to Princeton, then graduated. And after college, I worked in investment banking because I didn't really know what else to do. And there seemed to be a lot of good jobs there. And so I got assigned I was at first Boston, then now Credit Suisse. I was assigned as an analyst in investment banking to work in the financial institutions group. So doing like insurance company, M&A, and asset management M&A, and also debt and equity. We do deals for Prudential and MetLife and companies like that. So then after a couple of years, traditionally back then it was a 2-year program, and then they're like, John, you're doing a pretty good job here. What do you want to do? And I'm like, well, I really want to go somewhere overseas and do something different. And back then they had offices in New York, obviously, London, Paris, Hong Kong, and also Australia. And so they're like, where do you want to go? Well, back in college, and also France, actually, was another option. So London seemed too similar. Back in college, you got a B- every time I took French. And that was, I think, as far as I could tell, the lowest grade they gave out. So my foreign language skills aren't the best. So France is definitely not a good fit for me. If I can't speak French, I'm definitely not going to learn Chinese. So Hong Kong was a little intimidating. So then you're like, okay, how about Australia? So I moved down there and didn't know a single person down there, and just spent a couple of years there doing investment banking deals. And we demutualized a company called the NRMA, which is the biggest insurance company. Did listings for companies like that, and so it was a really great time there.
And so from there, you stayed in investment banking, and then was that your first exposure into kind of the real estate finance world?
So I came back from Australia after a couple of years, which is a hard decision because it was a great place to live, and I could have, one of a few times in my life was a real pivot where I could have gone this way or this way, and I would have been very happy living in Australia. But came back and outstanding timing. I came back right in 2000 and end of 2000, beginning of 2001, and it was right when the dot-com bubble was happening. And so, and at the same time, my firm, First Boston, bought another firm called DLJ. So you had two firms merging. It's a doubled number of staff at the same time that deal volume was going down precipitously. So it wasn't a great time to be in investment banking. So I got an offer to go over to Deutsche Bank, still in their investment banking area. And so moved over there and worked in their investment banking area for a couple of years. And then so none of this has anything to do with real estate. So while I was at Deutsche Bank, DB actually was looking to buy a mortgage lender, actually a multifamily lender, a company called Berkshire Mortgage then. Now it's been renamed. But in the commercial real estate group, knew nothing about like buying companies. They were good at making real estate loans, but they weren't like corporate finance or M&A people. And so I came in as the internal advisor, basically, to structure this acquisition of Berkshire Mortgage on behalf of the commercial real estate group. And so did the deal. We bought the company, then worked on the integration for a little while. And then at the end of that process, I'd gotten to know pretty intimately all the people in the commercial real estate group. And so I walked into my boss's office, a guy named John Vaccaro, and said, John, I really love working here. I know I've never done a mortgage in my life, but, and by the way, at that time, Deutsche Bank was the number one commercial real estate lender in America. So they definitely knew what they're doing and had a lot of volume. And so I would like to get a job here. He's like, that sounds great. Let me come back to you, talk to the rest of the team. Came back to me in a couple of days and said, John, we'd love to have you here. And so I asked him, what's my job? We're going to make you a large loan originator. And I didn't even really know what that meant. It sounded pretty good because large loans sound better than small loans. But really it meant I was one of 4 people in the group doing all the biggest deals for the biggest commercial real estate lender.
That's not intimidating at all, no?
I should figure this out. So I started, first thing I did is I read the documents, which, by the way, everyone listening to this, if you're in the mortgage world, and Kevin, you'll definitely agree with this, the best thing you can do is actually read, front to back, a loan document, understand everything that's in there. I think a lot of people don't do that. But that was the first thing that I actually did. And then I started doing deals at Deutsche Bank. And I wasn't the real estate guy. I was kind of the corporate finance guy. So I'm like, I got to find a niche for myself. Because I'm not going to finance malls or office, but I could, but like other people are doing that. So I had to figure out something. And right around then, it was a big, this is probably like 2003, 2004 era. And then there's a ton of M&A going on with just leverage finance and leverage buyouts and everything. And one of the big ones was a company called Toys R Us. And so Toys R Us had a bunch of toy stores. Now it's bankrupt and whatever, it's getting crushed by Amazon. But that was a different era back then. And they had tons of toy stores that are getting bought by private equity. And normally when you buy companies like this, historically, you would just finance that in the corporate finance market. So you go to like the bank, you'd issue high yield bonds, you'd get bank debt. You wouldn't go to the real estate market. And so I came up with this idea that was really unique of taking all the because the company had a ton of real estate. And I said, why don't we take that real estate, take it out of the company, create a new entity, lease it back into the main parent company, and then finance that real estate in the commercial as a real estate loan, which is, by the way, much cheaper. You get more proceeds and lower costs than you do in the corporate finance market. And all the private equity funds thought that was awesome. They're like, this is the best thing I've ever seen. We get more debt and it's cheaper, which of course makes the returns better. And so did that deal, and they did many other deals like that, all what's called OpCo, PropCo, where you're taking corporate real estate out of LBOs and financing it in the CMBS market. And so did a ton of those deals. It did I think it was like $30 billion worth of deals over like 4 or 5 years.
And that's now standard practice, by the way, for our listeners. So it's most owner operator big corporate commercial real estate transactions happen with that kind of situation.
It was a crazy time, and we built this whole new market. And then the financial crisis happened. And the last loan I did, which is an opco propco loan right before the crisis, was a $2.5 billion loan to a casino company. And then, back then the conventional wisdom was that casino companies are recession proof. We learned that, when you go through the Great Recession, people lose their jobs. Obviously, they don't gamble as much. And so, that deal was kind of committed in 2006 and then closed in 2007. And a couple of years later, the company went bankrupt. So I ended up spending years of my life actually in Las Vegas and Reno in bankruptcy court, sort of learning all about bankruptcy and, litigation and cash collateral orders and all this very complicated bankruptcy stuff. Because we ended up being the threshold creditor in this entire bankruptcy. And so our borrowing entity, ended up trapping cash throughout the bankruptcy, and we used that cash actually to buy our parent company, which is kind of crazy. And then, at the end of this process, got to, actually went on the board of the parent company of the casino because we ended up taking over the equity of it and partnering with the management team, and learned a lot about casinos, a lot about Vegas, and got a deep exposure. And I could have, the second pivot point in my life, I could have stayed in Vegas and become a casino executive because I got, after spending years kind of working out this casino company, get to know the executives really well and become friends with them. And so that was sort of a choice, but decided not to do that. So I came back. And then this is kind of where the relevant story here begins. And then right when I got back, it's 2012, after a few years of kind of working this stuff out in Vegas. And February 2012 was a month that kind of changed my life. I got calls within the same month from Blackstone and then Lou Ranieri. And I had the reputation of being the guy to figure out kind of esoteric stuff because I was doing all these opco propco deals and things like that. So a lot of the other stuff kind of came to me. And so they're like, John, we want to go buy some houses. We think they're cheap. And this is 2012, right? What do you want? How are you going to get them? We want to buy them at foreclosure auction. What do you want to do? We want to buy like 10,000, okay? And we want to go renovate them and then rent them out and operate them as a rental portfolio. And that concept, literally in the abyss of the deepest time in the housing crisis, private equity started coming in. That was really the first call that really was kind of, okay, we need money to go do this.
That was when the iBuyers really started to make a move in the space in 2012. Yeah.
First moment. Yeah. And, but then they had no idea how to finance this because, is this, you imagine we get a new asset class and no one's ever financed a portfolio of single family houses in the country before. Is it residential? Is it commercial? It's a commercial real estate business purpose, right? Because you're buying a portfolio and you're renting them out, but you're also renting out houses, right? And so they're single family houses. And so, where does it even fit within the organization? I was a guy in the commercial real estate group doing casino loans. I'm like, yeah, that sounds great. So I dropped everything else. I partnered with the Resi group internally within DB to avoid that fight. A guy named Ryan Stark, who's really an amazing person, a great partner. And then, built up a practice internally to start doing this. So from like October of 2012 through October of 2013, we did $5 billion worth of loans because we were the only bank in town that was sort of financing this. And this is overnight, like the sexy kind of trade all the big private equity firms were doing. And that was a little bit of a scary time because that was a lot of money, even for Deutsche Bank. And, after we got the $2 billion, the guys in Germany said, hey, John, that's kind of a lot. You got to slow this thing down.
There was a lot of headline risk on Deutsche at the time, I'm sure, because of the mortgage meltdown and everything. So that makes sense, yeah.
And then, I had to promise that this is a scary moment. I'd write a letter to the CEO of Deutsche Bank saying I was highly confident that we're going to figure out how to securitize this stuff, even though it's never been securitized before. And so after $2 billion, we had to sell the rest of it, the next $3 billion over to all the other banks on Wall Street because they capped me out at $2 billion.
And these were bridge loans? We wouldn't
even know that term. I didn't know what private lending was or this whole industry actually. Yes, it basically was, but we didn't call it that. We called it a revolving line of credit over to Blackstone, and they could buy the houses and then renovate them. We wouldn't do draws. We'd just do like two fundings, one at the beginning, one at the end. And then they rent them out. And then the idea was like, once they're rented out, we have to find a real financing that had never been done before. Now it's a big market, right? But like at that time, never been done before to take it out.
Right. Perm rental was not a product. It was not a product back then. No, no. That's interesting because like, and was this mostly on the eastern seaboard or was this all over the country?
No, it's all over. They're very little on the Eastern Seaboard actually. Because the Northeast, the taxes, insurance, and prices are too high. So, I mean, the best places were like Atlanta and Riverside, California, and Texas. Kind of I'd say South and Southwest markets. Florida was a big market where there's just things were really inexpensive and yields were high.
Right. It's funny because like 12 was when in our purview on the West Coast and us working with some of the more legacy quote unquote hard money guys, it was when they started realizing, hey, there's some real juice to this business because they were just doing it. It was all kind of a second part of their business. They were all doing non-QM, basically what we call non-QM today, and this was all kind of a side piece of their business. And then eventually, and 12 was the year we all had to deal with licensing, and they all jumped into it because they were exempt. So, and that was the year. That's the year Dodd-Frank came out, and we were all like, wait a minute, we can do this without a license. And so that was the year everything just kind of shifted at the local market. And I remember hearing about the iBuyers. At this time, I was at a bank, and I remember hearing about. Actually, I wasn't at a bank. I was working at a law firm. I remember hearing about like big institutional investors buying homes. And it was the most head scratching thing because banks don't buy houses. Like it wasn't a thing. Investment banks don't buy houses.
No one thought it was even possible. It wasn't even a concept. And by the way, the practice was insanity because they started from zero and went up to buying like 10,000 houses, a lot of houses, right? And you're buying them one by one in foreclosure auctions. So they would actually show up with, in Georgia, you had to show up with cash to buy these houses in a lot of places. So you'd have guys with like armored trucks and literally like $20 million, $25 million in cash, in these like, all this stuff, like walking these foreclosure auctions, just bidding on houses with like, tons of cash. It was absolute insanity.
Yeah, and structuring the transactions must have been foreign because, like I said, you had to do it as a revolver because no one understood the idea. How do we do these loans? There's no formula at the time, and they weren't going to look at the local markets to figure it out because it's too far of a disconnect. So this is still a Deutsche, right?
It's still a Deutsche, and then the hardest part actually was like once these things were done, okay, and we had them renovated. How do you finance the renovated houses and with tenants in place? And what's wacky about this is the American system for financing investor properties is kind of really bizarre. Like, if you go to Fannie or Freddie Mac in this country or indirectly to them and you get a loan, they basically treat it like you're a homeowner. I mean, they underwrite you the same way they underwrite a homeowner. There's no different rules for investment properties. And so they're looking at your income and verifying your employment and all these, your FICO score and all these concepts it's almost like they had this like monster, like someone that created Freddie and Fannie, and they created a monstrous sized entity that would just was doing, owner occupied kind of loans. And they're like, oh, we have this investor stuff. Let's just do that. Let's do it the same way. It's not.
It was an overcorrection to the reaction to the market because they were like, well, it's all subprime. It's regulated the same way. That was my perspective on it. Yeah. So what happened after that? So how'd you find the perm loan? Was it Fannie and Freddie, or was it?
No, well, they wouldn't do it because they were underwriting. It wouldn't work. You can't go to Blackstone and get like 10,000 houses, and so we had to basically look internationally. And so I spent a lot of time looking at the English market actually, and they have this thing called buy to let over there, which I thought was sort of an interesting concept. And by the way, that was like everyone it seemed like, I don't know, like a lot of people in the country, individuals would buy houses and rent them out, and they would get loans based upon the rental income, not based upon their personal income. And so I'm like, well, that makes sense. I'm a commercial real estate guy. If you finance a hotel, I mean, you look at the cash flow of the property. Why would it be if you finance a multifamily property, you look at the cash flow of the property, why would a portfolio of single family properties be different? But it just wasn't done. And so we had to create all these rules on how we're going to underwrite this cash flow and figure out like, okay, well, you know what the rents are, but what's the vacancy rate? No one really knows. How much crazy. We spent like months and months and months, Kevin, trying to figure out how much it costs to actually maintain a house. And by the way, you would think that would be a simple question because we have so many houses in this country. But actually, there's basically no data on that, on how much it costs on average over time to maintain a house. So we had to kind of make it up. And so we created this way of underwriting it. And then then I went over to the agencies and had to get them to rate it, right? And that's hard because, the Big Short just came out. And so imagine me walking into, Moody's and saying, hey, I know you just read this book, and, I'm not a resi guy, so that's good. I'm a commercial real estate guy. But we have this great new idea. We want to go finance a bunch of single family properties in a totally different structure you never heard of. And we need a lot of AAA. It's going to be great. And you can imagine the tough sell.
Let's call it reticence. Yeah.
By the way, all these people saw their predecessor get fired, right? So it's okay. And then we it took from March 2013 until October 2013 to get the agencies on board with this. And we got Moody's and Kroll and Morningstar to sort of rate the first ever deal. And ultimately securitized that in the end of, I think it's October, November of 2013.
That was a perm rental product, right?
Yeah, it's a permanent product. So we had a term loan on once it's renovated, all the renovated properties went to a new financing vehicle. And then we went and got that rated and securitized. And I've done securitizations for a lot of my life. Securitization is not that sexy. You go and try and sell bonds, you may get, I think the biggest ever number of people I ever saw in a room on a marketing show or marketing effort trying to sell bonds was 10 or 15. So we're going there in that first Invitation Homes deal in late 2013. And it was overwhelming. The demand is just off the charts. We had to rent off the Waldorf Astoria in New York City. And if you walk in the front door on the left, there's a massive long room. We rented that entire room and had standing room only. We had 380 people show up in that room. And we had to have guards, and we were turning away the press, and people weren't authorized to come in there. And we had people up in the dais up in front with massive screens and everything, sort of almost this is not the Google IPO, guys. It's a bond offering. But the excitement from the investor universe was so high around this deal. It was just overwhelming. And the deal went really well. We sold it much more better terms than we expected to, and we're super excited about the reception we had. And then I'm okay, so that's great. And then during this whole process, I'm well, okay, I've figured out how to go lend to the big institutions who are buying thousands of homes, but 98% of the market is everybody else. And those other people really have no options. You can't go to Fannie and Freddie if you own an LLC and get a loan. They underwrite you based upon your income. So that concept of cash flow based underwriting for single family properties, really needed to be applied to everyone else. I went to Blackstone and I came up with a, pitch. I'm hey guys, we know how to securitize this now. I can do it again. What if we set up a company to go do this for everybody else, right? For smaller investors who are looking to buy 5 homes, 10 homes, not the Blackstone size, but much, much smaller, but frankly, a much bigger market. And so I got hired to start up a company called B2R Finance, which, by the way, in homage to buy to let, which is how I discovered this whole thing, we called it B2R, which is buy to rent, right? So it was being respectful to kind of the UK heritage, I think, of this, the concepts around the asset class, and then started that. So that's how I got started at B2R.
That's fascinating how it comes from the UK market, because their finance, we joke about how Canadian and the UK regular mortgage market is so different than ours. And so fascinating that the DSCR product came from there. That's actually pretty cool. Now with B2R, was B2R primarily a rental lender, a perm rental lender? Because I remember it being, at least after I joined the industry, being a full-fledged private lender. They did everything.
It morphed over time. So like a lot of things. So at the very beginning, it was just going to be single-family rental portfolios. A small, 5 houses, 10 houses, really small portfolios for smaller investors. And we did that, and then we built that up. We did about $1.5 billion of lending over the first couple of years. So it was the investor demand was out of control because we're once again the only game in town kind of doing this kind of concept. And then we added over time. We bought a company called Dwell, which is a bridge lender, and then we started doing bridge loans and added that, and sort of added on to the core over time.
Added on to it, and you added commercial and all that other stuff. And then so the The interesting part is the industry is full of B2R alumni, and I'm always fascinated to meet people. They all know you, and they all work with you over there. Like, so you worked there you formed the group, you founded the group, you built it. What happened after, during the life cycle? Because there's not a lot of time between that and the founding of Toorak.
Yeah. So it's about 2 years, right? So, by the way, it was crazy. Just, I don't know, this is probably an interesting story for people, but when you start off a new company, you think like Blackstone, they have like a whole like massive team that like sets up companies and everything. And actually they don't, because Blackstone doesn't really set up new companies. I mean, they tend to buy big companies and they're good at that. But, like, they're not a venture capital firm at its core. And so I remember, it's kind of a funny story. So like right at the end of October, where I was leaving Deutsche Bank, I emailed the guys at Blackstone. I'm like, I'm coming over. I haven't gotten like a drug test. I haven't gotten like a background check to my knowledge. Where do I go up to show up for my new employee orientation? And I still have this email somewhere. The answer is, you're in charge of figuring all that out. And so that was kind of like that, oh my God moment where it's sort of real.
Like you had convinced them to back this company, but it was more of like, all right, you're on your own now. Here's some money. Go figure it out.
And by the way, you're used to working at Deutsche Bank where like you call up the IT department or the help desk.
Yeah, you have this giant infrastructure. You're part of this massive global company. And then you go to being a startup. That must have been really scary.
It was totally scary. There's only one guy over there, again, Jeff Tennyson, actually, who was hired right before me and became my chief operating officer. I was now the CEO of Lima One and a great friend of mine. But we sat there and so the first day I got like literally the LLC agreement for the entity. It just formed the day before. And I had to go across street to the Wells Fargo branch and go there and open up a bank account. And so that was my first morning. And then the next day I got $5 million wired into the account. And I'm like, okay. This is
now
real. And then they're like, okay, they put me in an empty office in the HR floor. And they said I had 2 weeks to get out and find my own place. It was a trial by fire. But then we, went off and just worked, 24 hours a day for months and months and months, hiring a lot of people who are amazing people in this industry, Anthony Kazazians, obviously Eli Novi, who works for me, Devon Patel, who now runs his own lender. I mean, a lot of people who have gone on to have really successful careers in our industry. Then we ended up hiring over that first 6 months. I was just interviewing 7 people a day at some points.
This is the time when now private lending is really starting to get some horsepower. In 14, when I joined the industry in 14, and in 15 we noticed the firm doubled down in 15 because we realized there's a lot of horsepower in this space. More than we were actually doing more commercial work than residential work, and we saw just massive horsepower being pushed behind this fix and flip. We call it now RTL, and we were noticing this is within the emergence of these national, global backed, institutionally backed organizations started to pop up. Like you guys were there, B2R, Genesis here in LA was really growing. Colony was growing. We joke around. That's when the spiciness began, because it just started getting really, really interesting, because we didn't really believe that there was that much volume in the space to be done with. But so how did that evolve into you going into Toorak though? Because that is B2R, it took off. I remember taking off. And I mean, being institutionally backed, there must have been a lot of trials and tribulations with the fact that you've got Blackstone behind you, right? Because there's a lot of stress from that. But and they're on both sides of the deal, right? They're buying houses as well. So how does that transition over to Toorak?
Well, it was great. So when I was there, we did the first ever securitization, a multi-borrower securitization. So we figured out how to do a different, not one loan to Blackstone, but 70 loans to different people and put that
multi-asset actual. That was the first RTL securitization, or
no? That wasn't RTL. That was still term loans, but that was the first multi-borrower term loan securitization, and that was a different type of underwriting. And we had Fitch rate us, which was they weren't involved in the other deals, so it was kind of a new big agency that got involved in our space. And then what I realized after a couple of years is that 2 things. Number one is that building a lender takes a lot of time, and we did $1.5 billion over 2 years, but still, there's a finite growth pattern to building a lender. And number 2, I kind of learned about this, RTL space, fix and flip. I don't love the term, but back then people were calling it hard money. But I learned about this industry, and it fascinated me because you think about the mortgage universe, and I've worked in commercial real estate and resi and sort of big institutions. And you look at the mortgage universe and you realize that most of it kind of operates pursuant to a pretty consistent pattern, even internationally. Like you have a pretty clear set of guidelines for what's a residential mortgage loan. There's a 1,500 page Fannie Mae seller guidelines that define everything that's a home loan. Same thing for commercial real estate. There's rating agency guidelines and clear criteria around what makes that. And so you have a pattern where like lenders make loans according to rules. They ultimately go to Wall Street. Wall Street takes those, they package them up, they securitize them. And then that's how the whole rest of the mortgage universe is financed, except for this industry. And this industry was really the anomalous one. And it's kind of bizarre because you're like, just like when I started off at Deutsche Bank in that first Invitation Homes loan, is it commercial or is it resi? This thing kind of fits in that middle somewhere, and that they're business purpose loans, but they're usually on 1 to 4 family properties. And so they're kind of in the people, the world in the mortgage world tends to be divided into 2 groups. Like you're either a resi lender, in which case you tend to think about statistics and about large pools and about data, or you're a commercial real estate person in which you underwrite every single loan individually. And there's very little overlap between those 2 universes. And
this was the overlap.
And this is the overlap, right? And so people, the commercial, I remember going to my boss at Deutsche Bank and saying, hey, I want to do this. He's like, that's too much work. I mean, it's too many loans. They can't possibly understand that. And then you go to the resi guys, they're like, oh, you can't, put numbers around this. You have to actually analyze these loans individually because there's stories around them.
You can't price. I remember hearing that all the time. You can't price these deals. Like, well.
And so it ends up being in the middle of the 2 worlds. And so, but then I realized, okay, at B2R, that there were 400, at least I knew of, there are probably many more, private lenders across the country. And they're making, we call them bridge loans, right? And these were 1 to 4. In 2016, when I left B2R, the eureka moment was, I looked at my town. I live in Short Hills, New Jersey. And if you wanted to, at that point, if you want to go buy a house and live in it, you get an 80% loan to value loan from thousands of lenders around the country at about, 3.5% interest rate. Now, this is the moment. If you were an investor, and by the way, you can go to LendingTree and like the brokers would call you till your phone battery would die, trying to get you to take their loan. If you wanted to so much demand for those, if you were an investor, wanted to buy the exact same house and renovate it, you get this number's been disconnected. No one will call you back. Okay. No one has any bid. And so you end up going to like local lenders who are, have their own capital. And the interest rate for the same house was 14%. And the, loan to value was 65%. And so I'm like, even I can't screw this up. I mean, this is so juicy and so attractive and so much economics in this because no one from kind of the mentality of the rest of the mortgage world has sort of found this little industry and applied kind of the concepts that work in the other parts of the mortgage world to this industry. And so that was the idea behind the beginning of B2R. That's
funny you say that because from a contrasting standpoint, I remember how it was. I remember 16 how it was here in California, and by that point in time, it had already become kind of a standardized, like in LA and Orange County, in the major metros in California, it had already become widely accepted. Like my banking friends were calling me to place loans with my clients because it was kind of widely accepted here in California, and I think it comes from like the large volume of commercial real estate brokers you have here. Because I mean, if you ask Uncle Chuck, I think Uncle Chuck is the best example. He's Chuck Hirschon. He's probably been doing private lending for about 40 years. And I asked him about like, what was the first resi deal that you ever did? And it was a bridge loan. And he said, we underwrote it like a multifamily deal. And we didn't know how to deal with it. So we knew multifamily. We underwrote it like multifamily. We charged them 12%. And it was, he said actually back then it was 18%. And this is like in 1970 probably. I mean, Uncle Chuck's been in the space forever. And he said, that's how we did it. And if you look at the demographic of the legacy lenders who've been around more than 10 years in our space, especially on the West Coast, they're all commercial guys. They've all come from the commercial sector, or they're all real estate brokers that became private lenders. Very few came from conventional mortgage or except for a handful of guys. And shout out to Mark Wazzillo and his family. Like they jumped into the resi space, but most of the people came from commercial, and I think that it was a lot harder to we were starting to hear about this on the East Coast probably in the beginning of 17, where the volumes were picking up out there, and like guys from Texas were doing deals in New Jersey, and we were hearing about this, like, oh, because they're chasing the yield. And so it was a fascinating time because there was a lot of horsepower at the time. And you guys opened shop in 16, right?
Yeah, 16.
Toorak opened shop in 16. So give us the story now. We're at the Toorak segment of the podcast. Give us the story there a little bit.
It's definitely just on the industry, though. Before I do that, California has always been, it's a birthplace of this industry. I mean, the anchor is the granddaddy, in my opinion, of this whole industry that's been around forever. Have a huge amount of respect for the company.
Steve started doing this 20 years ago, he said. So
Yep.
yeah. Yep.
And so in that company, when I started off, was the only company that had any data on what happened during the financial crisis to bridge loans. And it definitely started in California and then moved east.
Right. The concept of this, I'm going to buy a house, renovate it, and sell it, was foreign. And there was guys that were living there and selling them within a year or two, but there weren't guys that were buying them particularly in 6 months and get it off the market. It wasn't happening. I think that was a product of volume coming off the auction.
And the big lenders, the original lenders, were all from California.
Yeah. I mean, they were. I mean, also, I give a lot of credit to the East Coast. There's a lot of folks out of Florida and out of New York that came out doing stuff too. Just that, they were doing a lot of like what you guys were doing, a lot of rental stuff and other multifamily stuff, and they started doing the flip work later down the line. So
then I left B2R and I really wanted to start my own fund. And I originally actually I was a little scared about raising money because I didn't know how to do it. So I had a pitch book with 10 different ideas in it. And because I thought if I went to the investors, I did idea number 3, I could flip to page 7 and have another idea. And I had 3 meetings and they were like, John, these seem interesting, but like there's too much here and we don't know what to do with you. But very nice.
Well, who are you pitching, by the way? Were you pitching your friends at the investment banks or?
No, yeah, everyone I knew, Lou Ranieri, I talked to him. I talked to hedge funds. I talked to private equity funds. I mean, I network. I worked in Wall Street for a while, so I know people who know people. But I had 3 meetings. Then I went back to my library and sat by myself for a month and deleted 9 of the ideas and then leaned in on one. That one idea was we're going to go partner with lenders around the country. We're going to buy residential bridge loans and we're going to finance them. And before I went back out and talked to another investor, I went over to Deutsche Bank and my old friend Ryan Stark. I'm like, okay, here's what I want to do. Can you give me a term sheet? And he gave me a term sheet for financing. And then I went to a bunch of the lenders I knew in this industry, RCN Capital and some other ones, including my prior firm, B2R. And I got term sheets from them on where they would sell me loans. So I knew where I could buy the loans. I knew how I could finance the loans. And then if you know that math, you pretty much know what the economics of the business are. And then I went around and I ended up, talking to, I think it was 23 different investors and got 3 different offers, including one from KKR. A guy named Dan Peterzak, who's still the main guy at KKR we work with, and then got funding for B2R and Toorak, and then started Toorak, and we got going in like February 2016. Our first loan we funded in August 2016.
Was that another startup situation? That was another like, okay, we're starting from scratch. I got to go open the bank account kind of fact pattern, or was it a little bit more kind of like, all right, we're going to help you out here?
Well, first of all, I knew what I was doing. Like we kind of figured it out before. I knew I had to set up payroll and insurance.
Right. You had set up business before, so you had that part of it. You had the skill set internally, but now your investors. Was it more of like a passive role, where they're gonna like a fund investor?
Yeah, they give us equity. They control the board and they give us equity, but they're not operationally sort of doing the business, right? And I had a lot of great people from B2R, like Eli Novi and Coco came over as my CFO. Coco came over; she's now the treasurer. Devang Patel came over and ultimately headed loan acquisitions, and Darren Weaver came over and ended up doing, and all these people are still either working for me still or as leaders in other companies in the industry. So we had a lot of great people from B2R who kind of were with the start, came from a startup background who understood it.
So let's talk about kind of like evolution of Toorak. So at its initial thesis, was it originally to buy loans?
Yeah, that's it. We're going to go to lenders around the country and we're going to say, here's our credit guidelines. If you make it look like this, we'll buy everything you have. And that mentality, they never heard that really. So I'm a million miles in United Airlines, mostly flying around the country talking to people about this. And when we started off, like people were kind of wary. Are you going to compete with me? You're going to take my customers? Like, who are you guys? You're the guy who just ran B2R. Now you're coming over here trying to partner with me. It's kind of weird. And so we had to convince them, hey, we're real, we're reliable, we're consistent, we're going to be here for you, and we're going to buy loans as long as you make it look like this. And what happened is you need to fundamentally homogenize the industry, right? So, like having done this in 2016, the amount of different ways people underwrite loans, it's like everything's totally different. It was almost like it was like region by region. Like the people in Phoenix do it one way, the people in Miami do it a different way, and you've kind of created this balkanized kind of world of how people operated based upon their local competitors. It's a very localized market, which is different than the rest of the mortgage market. And so we had to go off and say, okay, well, if you make it look like this, we'll buy everything you have, and we'll buy it at a much lower rate. And a lot of lenders, jumped on it and said, this is great. And, we're going to change what we do to sort of, do it the Toorak way. And then those lenders, a lot of them are top tier lenders in this industry right now.
That box you guys put out to the market early stage, was it back then? Was it also, because the big fundamental change I remember was our clients complaining like, man, they require FICO and appraisal, right? and that was not a commonly done thing in private lending back in 16. And it's still not done by some of our clients. So was that part of it? Because I remember there was another buyer who will not be named that was on the West Coast that did not require those things. And so I have one question to you, whether you guys required it.
Yeah, no, we did require FICO, we did require appraisals, and we still do. We're a little bit more. We have different kinds of valuations now, so there's a little bit more creativity on the valuation side of time. But at the beginning, that was it. And because what I was doing is I was thinking, okay, well, by the way, these loans were so expensive. I mean, you're talking about 12, 14% loans, and so I knew rates were going to come down so much because it was so juicy and so wide and inefficient. And I wasn't thinking about what the industry was then. I was thinking about like what is going to happen once it gets kind of institutionalized. And I knew in order to go get bank support, in order to get good financing terms for me, in order to ultimately securitize the product, that I needed to have the basic things that institutional investors expected in mortgage loans. And so the pitch was, hey, if you get an appraisal, here's the rate. If you want to keep it yourself, you can keep your own rate. And so
that was the key difference then. So that's you knew you were going to securitize from day one.
No.
No?
I knew I was good. Originally, the plan was just borrow bank debt and finance it with not till 2 years after we got going that we did our first securitization in 2018.
What clicked that, okay, now I can securitize this? What clicked in your head that was possible? Because at the time, there's only been, if I remember correctly, it's 18, right? 18 was the year?
Yeah, 2018 was the first deal.
In 18, there was probably, I know Beth's company was trying to push it, and maybe they've done one. You guys had done one. It wasn't a thing. Like nobody had figured it out. It wasn't really on the bridge, on the RTL.
Not bridge loan securitizations.
No one had figured it out. No one was able to do it. What like everyone conventionally thought this was a balance sheet play. So what clicked that allowed you? Was it an investor telling you? Was it for the audience who doesn't, when John's been talking about Lou this entire time, you want to give them the idea of who Lou is, because I know who he is, but you want to tell the audience who Lou Ranieri is?
Lou Ranieri is the godfather of mortgage-backed securitizations. He invented it. He's most famous for Liar's Poker. He's the star of Liar's Poker, that book by Michael Lewis, which is an amazing book. And he was at Salomon Brothers, and at that point he had left to go to work at a company called Ranieri and Company. That's obviously his company, but really just the godfather of the mortgage-backed securitization world.
Right. Was it Lou that told you like, hey, this can be done, or was it like something that you figured out for yourself? What was going on?
I worked in commercial real estate, and we did CMBS securitizations. And then I went over and did the first ever single-family rental securitization. And I knew how to go to the agencies and sell bond investors on this and what they expected. And I did the first multi-borrower single-family rental securitization. So I have a lot of background in like sort of selling bonds and structuring deals and understanding what the market wants. And so I was pretty confident that we put this together, and if we did it in the right way with the right collateral, the right disclosure, that we'd be able to get investors that are attracted to the industry and create a real market around it. So it's using the background that I had from all these other experiences and really applying them to this new concept.
The question though on that is, how did you convince them to kind of, because you said it earlier, this is kind of a weird, I always joke this is the bastard child between residential and commercial, right? This is the bastard child. RTL is smack dab in the middle. It's hard to understand. And 18, it started to become understood, but Wall Street wasn't really jumping into this sector. So how did you like that fundamental disconnect? Was it hard to unravel that for them, for the
Yeah,
investor?
originally I went to, first line was with Deutsche Bank, right? It was my partner at Deutsche Bank, and the Dan Peterzak, who ran, KKR, senior person at KKR, he came from Deutsche Bank. So the relationship depth at DB was really, really high. So that was, you have some relationships and that starts it off. But then, once we got the securitizations going, I spent, weeks on the road going to Minneapolis, going to Ohio, going to LA, going to Boston. I mean, sitting in, conference room after conference room with investors, explaining what this is and how it worked and how we underwrote the loans and what our philosophy was, and getting them interested in it. And so it was just work. I mean, you fly around, you spend a lot of time, and you tell investors what you are, and we explain that we're doing it in the right way. We're getting FICOs, we're getting appraisals, we're reviewing these loans in the way that you expect us to review them because we think like securitization people. And so we're taking this market that was not organized that way and applying kind of a capital markets mentality to it that allowed us to homogenize these loans, create the same loan that's underwritten the same way, whether it came from lender A in California or lender B in Boston, and pull those into a deal and give investors kind of what they want, which is something that's understandable and homogenous. And that was the key to kind of getting going. Now, that being said, before we did the first deal, I went to the agencies and, said, hey, guys, remember me? I'm the guy who did the other deals before. And I got KKR here and we want to get some ratings. And, DB came out with us and Morgan Stanley, and who at that point was funding us as well. And then we tried to get them to rate us, and they just said no.
What was the reason?
The stated reason was either it's not a priority, we don't think it's a big enough industry, or it's not a priority for us, or the generic answer was there's not enough data, which is just, kind of what they.
That's a legitimate one. I feel like that was very hard to get data back then.
Oh, but when we did the first invitation owns deal, there was zero data. I mean, it's literally a whole new loan structure that's never been created before. So it's a little bit of it's not really a priority for us right now. We don't want to do it. And I think they wanted to see some traction in the industry, some momentum, because the problem is after the financial crisis, I think it's probably good, but there's a lot of things that are both good and bad. After financial crisis, the country passed a whole series of laws that changed the way the agencies worked. And a lot of those laws did things like they separate the revenue side from the analytical side of the business. They also put a lot of more regulation on the agencies and a lot of hurdles in what they have to do to demonstrate a new asset class and like a new ratings criteria, which means that in order to do something new, the amount of work you have to do in order to get something going is just a lot higher than it was before, which in practice means they just don't do it. I mean, so they'd rather do the 20th non-QM or 200th non-QM deal and stamp it out, or another CMBS deal where they already have criteria it's approved, and so create something new. And so
I remember that happening, but I also remember when the non-QM deals were getting rated, and I was like, guys, it's a different loan product than what you were doing back then, but you had no problem rating this, but you're saying no to this stuff. And it's kind of like, I was like, guys, it's still a new thing, but they were already used to it because it was an owner-occupied deal.
Yeah, well, that's right. And they have criteria and history around it, so they can rate it. And so they said no, and so we had to do unrated, and that the market was unrated until this year, right? And we'll talk about that, I'm sure. But in the unrated market, the problem is if you're a fixed income investor, if you work at Fidelity or a big insurance company or a lot of these institutions, they have very little money for unrated bonds. I mean, the whole market for fixed income is based upon ratings. And so if you're trying to sell an unrated securitization, you're dealing with like 10% of the market. That's very small, which means there's not that many investors who do that. And you end up having wider spreads, or the interest rates, you have to go sell the bonds that are higher because you're dealing with a smaller market. And so the whole utopia was getting to a rated deal where you can open up the full range of the capital markets to be able to at least look at your deal and say, yes, I like it, or no, I don't like it.
Yeah. And I want to ask about that later in a bit when we get into securitization. I want to ask kind of some questions about Toorak, because I mean, today in private lending, Toorak is a household name. Everybody knows Toorak. Everyone knows who you are and Ketan, your team, and it's widely respected, widely used. In 2016, when you guys came on the scene, it was controversial, right? And there were some, I guess, mudslingers out there on the loan buyer side, and the lenders, originators, and the lenders. One of the accusations that was made was, you guys are pushing down rates. And I always wanted to ask you this specifically, because I think I've heard you talk about this. What was your response to that? Because I remember back, this was a big accusation back then. You guys are pushing down rates. We're not. Yeah, California was at one point, a fix and flip deal in California was in the eights. And so, how did you respond? How do you respond to that? Because back then, at least, because I don't personally believe it, but I believe it's a matter of part of the competition. But that was the accusation being made.
It's not me personally, but I think it's interesting. You have two different perspectives. You have a perspective of an individual lender looking at their individual loans, or you can step back and look at the market as a whole, which I try to do. For the market as a whole, if you look at, and there's data on this from Adam and other sources, the vast majority of flips in this country aren't financed. Okay, so if you're a first-time home buyer buying a home in this country, 80+% of first-time home buyers are going to get a mortgage. The vast majority. The vast majority of flippers in our industry don't access our space. And so my answer to that was, your biggest competition is not the lender down the street. The biggest competition is the product kind of sucks. I mean, they're first of all, the lenders don't fund. I mean, back then they didn't necessarily have capital. The reputation of some of the lenders wasn't necessarily the greatest. And the interest rates were extremely high versus other lending products. And the points were extremely high. And so the product was not a particularly attractive product, honestly. And so what we needed to do as an industry is change the product over time to a product that actually is appealing to the customer, so that the vast majority of our customers don't say, I don't want to access your industry because you're just too high. And then you actually change it from something that's a small industry, which is what's happened if you really think about it, to something that's a much bigger private lending industry, because we're actually solving the customer's needs. And so sure, you can do one loan at 14%, or you can do 100 loans at 9%. And you may make less money per loan, okay, if you're thinking about yourself, but you're creating a much bigger market and providing a better product to the customers. And I think ultimately that's what we want to do as an industry.
Oh yeah, that's what my response was when I talked about it on with people. This is a product of free market capitalism, and what do you expect? But the product's getting better, and the customers are happier, and you guys are making more money. So what's the concern? So that was my thing. I was like,
I'm still waiting for one of the borrowers to call me up and thank me, but I don't think they know who I am.
Let me ask you this. Toorak's evolved over the years, and so you guys initially started out buying loans, but now today, looking backwards, you guys have now added a bunch of components to your business, right?
And we started off just funding 1 to 4 family loans that we bought that are closed, and then we added I went over to the UK, which I still love because of buy-to-let, and I feel loyal to the UK for inspiring this whole idea. And then we started a business there, which is run by a guy named Tim Marsh, which is very successful over there. We're the biggest capital provider to they call it the bridging industry, not private lending, but the same idea over there. And then we had a multifamily, pretty early on. We added DSCR, which was, the same concept we did for Blackstone and at B2R, it's just one house, one loan, but still underwritten based on cash flow. That's a lingo for DSCR. It's a loan on a rented single family home. So we added that product, which I knew well, obviously from my history. We added, through a holding company, through an affiliate, we ended up buying a company called Merchants Mortgage, which is a direct lender based in Colorado. That's a very successful lender. So we have access to merchants as well over at Toorak. And so we added a lot of different sort of ancillary, we added ground construction and other sort of ancillary products so we can be more of a full service provider of capital to the industry.
And as they're doing all of this, is more product to the balance sheet. And then since inception now, before you did your first rated deal, how many unrated securitizations did you guys accomplish?
Oh, I don't even know. I would guess 10?
10?
Maybe 8, something like that.
A couple a year then?
Yeah. It's about 2 a year, cool. From 2008 to 2000.
A lot of traveling, a lot of road shows.
What's interesting, actually, after COVID, you can't get investors to do road shows anymore. We did because they like we're working remote, and so it turned over to Zoom, and so you don't travel as much, but it's sort of changed how you sell bonds. But when we did the rated deal, a lot of investors wanted to meet us because it was new and they're learning the asset class, so we did do a real roadshow for that one.
And when it comes to you mentioned COVID, like, you guys were founded in 2016, things were real great. 2020 happens, big first kind of punch in the stomach for our space. And then we had the rate hikes.
Yeah, we love COVID. That was awesome. And then the rate hikes. I mean, I joked that, that was a horrible year for everybody. And so,
yeah. And there was a lot of ups and downs. And one of the challenges that we noticed at the local markets, the complaints that we were getting is like, man, there's this giant smoke screen. Like, they all become either dependent upon companies like yours or partnered with you guys to sell paper. And the market had become this really bumpy animal in general, right? This very dynamic industry become very bumpy and very volatile. And there was this massive smoke screen, not just with you guys, but everybody, right? We don't know who's buying loans anymore. That was the number one question I got for a solid 2 years. In 2020, all the way into the beginning of 2022. And like, what was going on your guys' end? Because I always explain to them, guys, you have to understand the capital behind them is suffering just like you guys are. It's not just that, right? It's not just that if they could buy, they would buy, right? That was my explanation to them. But like, I will try to get more information for you.
Two things happened. First of all, everything was hitting all at the same time, right? After COVID, but for everybody on all levels, personally, professionally, business-wise, it was a tough time. But you had, number one, you had a massive increase in delinquencies, right? So, and by the way, and the governor of New York State gets on TV and says, "Hey, you don't have to pay your mortgage." The borrowers don't understand that means a residential consumer loan, not necessarily your loan, but it all gets blobbed into this big thing, and so delinquencies went up dramatically over that period of time. And we were trying to figure out like how to be fair to people, like try to figure out if people really needed help, how to help them, but also weed out the people who are trying to be opportunistic, and we're just trying to take advantage of the situation. So.
You had to go into asset management mode because of all the delinquencies. Yeah.
Yeah. Oh, yeah. We moved a lot of our staff over to asset management. We had daily asset management calls. And the idea was, let's try and be fair to people, but also, be disciplined around what we do. Right. And so we had to create all that in real time, as that's all happening. Simultaneously, we're trying to figure out what's happening in the housing market. And I think right at the very beginning of COVID, if you asked, 100 housing economists, they all deny this now. What was going to, because they're all like, we're experts and we're God and we know exactly what's going to happen. They had no idea. No one really knew what was going to happen. I remember, going back to the influenza pandemic and reading a lot about that and what happened to the housing market as a result of the influenza pandemic back in, after World War I, and trying to draw parallels for what could happen here. And I was kind of a little bit more bullish than most people, but I didn't think it was going to go down. Housing prices were going to go down a lot. But I think there are people who thought we're going to have another great recession, housing crash. And so you had a lot of concern around that. So you're trying to figure out like what's happening to the housing market and which market's going to hold up better and what types of deals are going to hold up better. So trying to figure that out and trying to manage our own inventory. That being said, we bought loans every single week. We never shut down our loan purchasing. And since August 2016, we bought loans every single week.
But I would guess that you had to be more selective at the time.
Yeah, of course, you focus on your best long-term partnerships in times like that, and you lean in on them, and you give them the liquidity you have. But we bought loans every single week.
One thing that I'm hoping for in the long term is we can figure out a way where we can get more transparency out of everyone, because everyone's just like, just tell me whether it was. I felt like a lot of folks they didn't want to be let down, and they would rather just know. And that was the pain I was having. Like, man, it sucks because I can't get you an answer, and I can't get an answer because they're busy. They're doing their own thing. So yeah, it was a challenging time.
We had webinars with our customers. We had conference calls. We were talking to them every day. We tried to be as transparent as we could about here's our box and here's what we're looking to buy, and then give people transparency. And at some point, we're like actually pre-approving loans. So like you have a certain bucket of capital that you guys can do, because what happens is that when people shut down, like water flows to the lowest point. The amount of demand we had, like our pipeline in the end of March 2020, went up by triple, because everyone but Toorak is still going. And so we had unlimited amounts of loans coming into us. And so then you have to sort of triage and tell people, okay, this is your allocation. This is what you can do, because there's just too much demand because everyone comes to you all at once.
Right. And the nice part about, the result of that though was it was a nice weeding out of some of the ones that shouldn't have been in the market or didn't do right, and kind of the cream rose to the top. And now where we were after that, now I'm going to kind of get into the rated deal you guys accomplished. So at our conference, you guys recognition. You guys did the first deal. It's a big deal. Everyone was really excited about it happened. We did not expect it to happen until much later in the year. Give us the kind of runway to that, because there must have been a ton of prep time.
I've been rejected by every rating agency at least 4 times. So
were you going back to them every year? Like, hey,
every year I would go to New York City and I'd go around and would talk to S&P and Moody's and Kroll and Fitch and
So the consistent motivation, I have to get this rated. I have to get this rated.
That's where, because you really think about the industry, we're really proud of like having a partnership and sort of helping to institutionalize the space, elevate standards, create a better borrower experience, all these things that are happening. And the ultimate end game of that, from a finance person's perspective, is getting a rating. Because then you're accessing the broadest portion of the capital markets, and you're fully turning your industry from an industry that's very parochial and very local into an industry that's totally accepted as a core asset class. And that's a moment, that's a coming of age moment, I think, for our entire industry. And so that was always the goal. And that recognition for not just Toorak, but it's us as an industry and the entire space, that we're fully accepted as a major asset class is a fundamental change for them.
So give us some more color about that, like the getting ready internally, because it must have been a big paradigm shift for you guys to get ready for that.
We gave data. You're talking to agencies constantly. We have Ketan on my team who led the deal, and Alexandra Semenowski, who came from a rating agency background and tirelessly would talk to the agencies like all the time, give them information, give them all of our track record. And as we got more data and more time, and now we're up to $13 billion plus of loans, like our data set became pretty meaningful. And then that helped. And so we're constantly there's going to be an inflection point at some point where we had enough data to sort of let them do their models.
Was that before the guidelines came out or after the guidelines came out? Because the guidelines came out, was it last year?
Yeah, the guidelines were the end of the process. That's like after we already gave them all the data, they did all their internal analysis. So the part you didn't even see that. That was like years before that. And we almost, actually, a little bit of backstory, DBRS and Morningstar used to be 2 separate rating agencies, and they merged. And we were, very, very, very close to having Morningstar rate us before the merger. That was years before, actually. And then they merge, and you can imagine when they merge, you have both turf wars, the charge, but also like you have 2 agencies that become one, so you have to figure out like their methodology and reconcile the 2 different, they get different ratings from DBRS and Morningstar and reconcile them, bring them together. That's such a massive amount of work. They basically said all new projects are off. So we probably could have gotten it done a few years earlier if that merger had not happened. But it did happen, and then we kind of got put on hold a while. But they always said, okay, we'll get back to you once we deal with all this internal stuff.
Was there any kind of the unexpected data points that would be kind of, I guess you can say, surprising to our listeners that they wanted to really get in on?
Yeah. Well, they asked us like what our data was, and like how we thought about loans, and some things that are counterintuitive, but for example, when we started off, we assumed that like days on market, which means that how long it takes to sell a house in a particular area would be a really good statistic. And areas where houses sell quickly probably going to have lower defaults than areas where houses take a long time to sell. Our data shows there's very little correlation with that, actually, which was totally surprising. There's other things that are highly correlated, like, how homogenous is that house? Is it $1 million house can be fine if it's in a $1 million neighborhood. $1 million house in a $250,000 neighborhood is going to be really tough to sell. So we learned that like the nature of that house and how homogenous it was and how conforming it was to that neyborhood was extremely important in underwriting.
That supports the old adage, like my mom always used to tell me, don't build the eyesore in a neighborhood.
Yeah, that's right. And we see that all the time. Developers want to build the biggest house, the nicest house.
Yeah. You gotta fit in.
having a lot more problems. And so it's not about the house value, it's about the neighborhood and consistency. And so we shared with DBRS Morningstar sort of a lot of our lessons and our data, and then they validated it with our information. So they were able to create their own criteria around what's important.
So there wasn't any like practice change or underwriting change or box change to the sellers, to the originators. It was more like you had been building out the foundation to get there already, and you had convinced them that your foundation, how you had been operating until now, was sufficient.
Yeah, because by definition, they were starting with our data, right? And so the beauty of that is that the way we do things ends up being, it's embedded in our data. And so that's kind of what they're building around, right? So by starting with Toorak and by spending all that time, it's helpful to have them think about us first. And then they also went off to a lot of other companies in the space and got their information. And after we got them going, and so they had, I think, 5 or 6 different big lenders in our space shared their data with Morningstar. And I appreciate that because that enabled them to get there. But it sort of helped because they started out with us. So it wasn't like they're coming up with their own ideas. They start with a data set and build off of that, which is helpful.
I see. Now, the execution of this deal, beyond just getting ready for it, I mean, what was the difference between your previous experience with your average unrated deal? Was it a meaningful difference in getting and executing on this deal?
The biggest thing was, there's a give and take on the criteria, right? So how can I explain this? So if you have a pool of loans that has, 75% loan to value and, a 725 FICO, just take 2 numbers, right? Or whatever, it's like something. But then these are all revolving facilities, right? Because these loans are 1-year loans, and the economics are not good to securitize 1-year loans because they pay off so quickly that by the time you do the deal, they're almost all gone already. So it's too short. So all these securitizations, including the unrated securitizations, are designed with revolving features that allow us to not just have the initial pool, but also have subsequent pools over time that we can put in. And so in order to do that, you have to have criteria around that, like rules. You can't put in, loans on Mars, right? You got to put in, U.S. bridge loans that have this LTV and this review process and everything. And so we had to go do that. And so when the agencies start out, the big issue when DBRS starts out, they're like, okay, the initial pool is like this, but you have a box, and the box is a little bit bigger. And if you're going to be really cynical, okay, even though this doesn't happen in practice, or it certainly hasn't happened in practice with our portfolios, but if you're going to be really cynical, you can assume that every loan that goes in there is the bottom left-hand corner of like the worst LTV and the lowest FICO and the least experience and everything. And then you have pool drift over time. And so they have to go think about, okay, well, I can assume that the portfolio looks like what it does day one. I can assume that every worst loan possible gets in the portfolio. And the ratings are different depending on which of those two is the right answer. And so we ended up going back and forth with them for a long time on, okay, well, this is our unrated box, which is bigger. If we tighten it up like this, what's the ratings levels? If we do this, and sort of iterating a little bit to sort of basically tighten up the box to reduce the amount of drift that could happen from the initial portfolio to the worst ever portfolio. So that would get the best ratings or, be able to sort of, create a deal that sort of rate well. So it ends up being a little bit of an iterative process to get to something that's kind of a sweet spot where it's kind of like the 3 bears. It's not too much flexibility. It's not enough flexibility. So we can't find loans. It's kind of, in the middle there somewhere. So
yeah, they're trying to force your hand to be very rigid, but that will kill the opportunity. So I see that. But now from a opportunity standpoint for you guys, is this now kind of, this is it? This is how you're going to do it from now on? Or is it going to become a mixed bag? What's your vision on this going forward?
The deal executed extremely well. So we did a unrated deal earlier in the year, and then we did a rated deal. And the rated deal had literally tripled the amount of interest in investors, and the pricing was much better.
Larger pool of investors, right? And more candidates.
New investors who had never touched our asset class before. So it was really exciting to introduce so many new investors to what the RTL market is and tell them the story of our industry and our company and get them excited about this and see them participate in the deal. And the deal executed really, really strongly. So we're really pleased with how it performed. So the economics are pretty compelling that we're looking to do more rated deals over time.
What's the difference, would you say, on the pricing to the lender?
Our pricing went down by over 1%. Like the spread was like a big difference.
And that translates to the end transaction. So, I mean, that's great.
Ultimately, yeah, that passes along to the ultimate, lenders and ultimately the investor, the borrowers themselves. And so it's all a virtuous cycle that once you have that capital.
And the criteria on the purchase, the box is not going to change. That was one of my concerns. As more ratings come out, is the originators are going to have to conform to the new expectations of what the rating agencies want to see.
Yeah, that's true. Like if you want to do, you either make it look like something that's going to fit into a securitization box, or there's other ways to finance that, but it's going to be more expensive. And so what you're going to see is you're going to see a bifurcation of our market that's going to happen over time, but just like the rest of the mortgage world, where the stuff that's kind of down the middle and conforming is going to get better.
Oh no, are we going heading toward a prime and subprime types private lending market?
Yeah. I mean, that's some version of that's going to happen because you're going to find the stuff that water flows to the lowest point, right? You're going to find the stuff that's the best cost of financing, and that's where those loans are going to go over time. It's just the natural economics of it. And there'll be other stuff that ends up, being held on people's balance sheet or going to low private funds or, other sorts of vehicles that over time will naturally be the stuff that doesn't fit into the rated security.
Which makes sense. I mean, the market is so fragmented that it can support both. I mean, conventional support. I mean, owner occupied supports both. So I mean, I don't see why not. Now, with one thing that we had sat down with one of our clients in San Francisco, and he comes from the institutional world and bond trading and all that kind of stuff originally, and his comment was kind of interesting. Is his view was, well, ratings mean a larger swath of investor. Now every fixed income investor can look at this, right? Every pension can look at this. Every insurance company can look at this. Not just the guys that are open to doing an unrated deal. Does that lead to a glut of capital, oversupply of capital into the sector? And I thought I was worried about it at first until I had spoken with Sean over at Fracassa, who told me actually the market is the lower end of the market is bigger than you think it is. Like the top, I guess he said top 50 lenders have about 20% of the market, and the rest of the market has 80% of the market. And so he was that from a volume standpoint.
That's it. I'm surprised by that.
That can obviously shift. Any thoughts on that? I mean, any comments on that? Because that was like a very controversial thought process in my head. Because I was like, this is concerning.
Well, okay. By the way, our industry is strange in that we have lots of private funds. I mean, no other part of the mortgage space has the depth and diversity of private, funds that we do in this space. And that's because these loans are short, they're relatively high yield, and they work for, just you don't have to lever them. You can just own them, and they're a good retirement asset. And that's why you have all these funds that have been operating. That's a big part of Drossi, by the way.
It's my primary business. So that's all I do all day.
You guys have really created a great presence in this space. Have a great product. Fund a lot of, or partner with a lot of lenders around the space. You've created, I don't know how many funds you've created, hundreds, and really created great expertise in this industry. But I think what's likely to happen, if you think about the reality of it, right? You have, kind of this capital that's really, frankly, much more efficient than, fund capital. And so I think over time, the market's going to both consolidate. So you're going to see that top, one X lender share get bigger over time and, become harder for smaller lenders to exist over time. Because the rate pressure is going to be high because it's going to be, hard to compete with this, lower cost capital. And you're going to see a bifurcation of kind of conforming and non-conforming loans that end up, if you want to have a high yielding kind of fund, you're going to end up getting with loans that don't work in the securitization market. So it's going to be a little bit of an average selection thing over time.
But that's the nice part about that is that's always been kind of the case for a long time. Even after buyers came to the market, it's like, I'll hold the deals that I can't sell. They're still good loans to me, and they're higher yielding, and our investors like them. And we'll sell the ones that we don't like, that we can fit into the box, and we'll sell them, right? So that's always been kind of the philosophy. I think it'll get exacerbated. I agree with you. It'll get much more like that. But at the same time, you have a lot of the local retail lenders that are now growing in volume that are now thinking about doing this themselves because this is quite lucrative for their investors too, right? They can add this to their capital. So they're happy to entertain it. A lot of my larger clients who are balance sheet lenders are thinking about doing this themselves. The second deal that happened after you guys was the Genesis deal, and they saw that as kind of like, oh well, if they can pull it off, so can we. And now they're talking to bankers and stuff like that. So I think we're headed in that direction, though.
We know of many. I've between one hand and two hands worth of people who probably will be issuing rated deals. So we're at three. New York Mortgage Trust came out with one. Genesis, I know there's at least five more that are working on it, to my knowledge, and so we expect it, which is, by the way, great. We want to have, it's healthy to have a big market, to have multiple issuers, to have depth of liquidity. It's that actually in the finance world, like more issuers means there's more investor interest in our space, means there's more buyers. It's just kind of liquidity begets liquidity, which is good.
Agree. It's a good thing. I mean, we want this market to grow. This is the right way for it to grow. It is a limit at the local level. So now going into kind of your vision for the future for Toorak, for the industry at large, like I'd like to get your thoughts. You mentioned you think that about 10, maybe more rated deals that might come out this year, going into 2025. And what's your prognosis or perspective on going into next year? Because we've heard all types of opinions and all types of thoughts. You're influential when it comes to understanding both the local markets and the institutional markets, and you've actually played an influence on what they're thinking. So, give us some thoughts on your end, what your perspective is on going into 2025, because a lot of folks would like to know.
Well, I think you have two sides. So you have the lending side and the financing side. So I'll talk about them slightly differently. I mean, they're related, but on the lending side, you see across the country, and we have for a while now, a very massive lack of supply, right? It's very hard for borrowers or investors to find properties to buy. There's a lot of lock-in effect with rates. And so, inventory in many markets low. It's getting a little bit better now. We're seeing the green shoots of sort of improving, but it's still really hard to find deals. There's very little foreclosure activity. There's limited distress right now. And so investors, there's just not much deal volume. And so it's harder for them to find deals. And so we've seen like margins for investors that we track have decreased over time, not a huge amount, but some. And they're changing the nature of the deals a little bit right now. And this happening for probably the last couple of years, away from like what we call paint and carpet or very light rehab deals towards more value-added transactions where you're adding more space or you're converting it from a single family to a two family or four family.
And more construction too.
More construction, tear downs, ground construction.
Yeah.
And so you're seeing, investors move more towards a heavier rehab side of the spectrum because there's, more opportunity there. And so it's not just you're buying something and flipping and make a profit. You're buying it, that's why I hate the term fix and flip. You're buying it, you're transforming it into something else, and then you're selling it after it's transformed. So I think that's going to continue. I think rates have been higher for longer for a while. So I personally think rates are going to be a lot stickier and continue to be stickier through this year than people expect, certainly than the market expects. But at some point you see, and by the way, like 5% rates are not, like they were that way for most of my career, like early on. So
I have no objection to a 5% mortgage rate.
That strikes me as like a kind of...
That's the ideal scenario I feel like, for a lot of us. Yeah.
So rates are going to be high, I think, for a while. And you have to be creative as a borrower to go find deals that sort of make sense. And you have to reject a lot more deals than you probably had to 2 or 3 years ago. And that's going to continue to be the case. On the financing side, I think you're going to see what's already happened, continuation of this institutionalization space, which I think is really exciting. I mean, organizations like Apple have in the MPLA, other organizations here have all been, I'm on the ethics committee at Apple, really focused on sort of increasing the accountability and the ethics and the, sort of the integrity of our industry as a whole by setting standards for ourselves and elevating ourselves. So I think that's a trend that's going to continue and is really important. I think, professionalizing our industry and sort of increasing our standards in the industry is something that I think is very important. I've been a big fan of, we used to call ourselves hard money and getting rid of that term and moving away from that towards, less offensive terms, less negative connotations.
I'll talk about that with you because I've always taken the opposite position. I've never had an issue with it, and I think it's because primarily when I was a banker, nobody cared about it. Like it was like, we can't do it. Go to a hard money lender. It was kind of like the perspective on it. But now that banking is kind of gone and kind of dead, I mean, we can't call ourselves private credit, can we? I mean, I don't know if we can, but
private lending.
And I have no objection to that either.
American Association of Private Lender calls. So I think that's
right. My big thing was always like, well, what I care is what your customer call, like to my client, right? What client? What does your customer call you? Like, what does your customer label you as. And if he labels you as hard money, then you are hard money. It's kind of, you can't force that conversation. You don't want to make him think like you're, what you're not. You don't want to act like something you're not. You know what I mean?
Yeah, listen, if you're an originator, you have someone calling you up and calling it hard money. I get it where you use that term. I also think that, we don't, in the minds of many people, the term hard money is associated with predatory lending, payday lenders,
You want to get away from that connotation. I hear
lenders
that.
of last resort. And if anyone in our industry knows, what's happened is that this industry is the opposite. This industry is very competitive. Borrowers have many, many options with lots of liquidity, with big institutionally funded lenders in all markets across the country. So this is not a market where lenders are forced to take these loans or don't have many options, or frankly don't have a lot of negotiating power themselves. And so I think we've evolved away from even how you described it, like you can't get my loan to go to a hard money guy. I think this industry is really providing an amazing service. And I always found it strange that if you wanted to go buy like a $50 million multifamily property and get a loan on that to rehab that property, that was called a bridge loan or a transitional loan. If you want to go buy a 2-family property and get a loan to renovate it, that was called a hard money loan. Now, what's fundamentally different between those two loans?
And there is no difference. And that's the funny part to me, has always been locally, like in LA, a lot of the bridge lenders in multifamily and commercial call themselves hard money lenders, right? And they don't price any differently. I have a client in Sacramento. They proudly wear the label hard money, but they also lend at 7% on a multifamily deal, right? On bridge loan. So and they underwrite it like any commercial lender would.
That sounds so hard to me.
Yeah, it's not hard at all, right? It's very much not hard money lending, but I feel like it's a weird, like on my end, I'm looking at it from how the borrower labels it, and that's kind of what I care about. But I get it. There's a negative connotation to, like, we're viewed as loan sharks. And my dad always just make fun of me when I joined this firm. He's like, "You're up in loan sharks, aren't you?" He made fun of me for that. So I hear you on that part, right? It's definitely an issue. And what's interesting is I went to a real estate show, and I was actually very pleasantly surprised. Like, I reflected back on our clients and how sophisticated they are, and how competitive they are, and how smart they have to be compared to the residential investors. And it's even the local guys, and it's really, I'm really, really happy about that. And it makes me very, like, happy to be part of that kind of industry. How about for Toorak? What are some things that you're working on, kind of for our listeners to learn more about, in the coming year, in the rest of the year, in the coming years? Anything new and exciting for them to know about?
Yeah, sure. We're looking at expanding our volume and expanding our presence across all of our markets, and so we're looking to find quality lenders that we continue to partner with. Really looking right now, we're focused on the ground up product, and we like to expand our volume of ground up lending. And so we have a team dedicated to that, and really a lot of focus on that over the next year. We think that's both a good product for us and frankly a real need for the country, because we have a big shortage of housing around the country. And so it makes me happy to sort of be part of using our capital to actually create housing, and also renovate housing so that families can move back into that. So I think that's a big focus for us next year. We expect to do more, securitizations. I'm sure we'll be out in the securitization market, accessing that as we go forward, continue to grow our balance sheet and grow our presence. So I think it's nothing radically different over the next year, but definitely a focused mix a little bit, and looking to grow.
For our listeners, if you guys are looking to work with Toorak, if you aren't already working with them, I know for a fact they're going to be out in force at our show in Las Vegas at the Captivate conference. So look for them there, and hopefully you can join them and take advantage of this their big push in ground construction. I think that's all the time we have for today. I want to give a big thank you to John for doing the show today. Really appreciate it. Also, thank you to our friends at the American Association of Private Lenders for co-sponsoring this special episode. And this is Kevin Kim. We'll see you in the next season for Lender Lounge. Thank you for listening to this very special episode featuring John Beacham with Toorak Capital Partners. This is Kevin Kim, signing off.
You've been listening to Lender Lounge with Kevin Kim, brought to you by Gerasi LLP, the nation's largest private lending law firm. Gerasi is the leading legal resource for specialty lenders, asset-based lenders, private lenders, and non-bank institutions. Learn more about the firm at GeraciLawFirm.com. That's GERACI lawfirm.com. Check out our episode summary to subscribe to our Lender Lounge newsletter and our law firm newsletter, where you can get notified about new episodes and recent content directly from our expert attorneys. In addition, we'd love if you follow Lender Lounge with Kevin Kim on YouTube, your favorite podcast platform, and on LinkedIn, where you can also check out updates from Geraci LLP. Thanks for listening, and we'll see you next time on Lender Lounge with Kevin Kim. This is Kevin Kim, signing off.